We have some interesting top picks on the list from these folks this week. And Tracy, we're going to start with you. You've actually got a Chinese company. Now, wait a minute. What goes here?
It's the first Chinese company I think I've recommended in like 2 years, maybe. It's been a long time.
We keep saying we can't believe the data that comes out of China.
Right, right. And after the reverse merger stuff going on over there and a lot of shenanigans with Chinese companies, I've mainly stayed away from them. But this is CTRP. They're big internet vacation travel site. They're like an Expedia or a Priceline here in China. And, you know, growth has just been phenomenal. So I'm kind of looking at it going, well, if you want to play on China and you want the expanding middle class, this is the way to get in. They are Zacks #1. They're not cheap, trading at 51 times, but the growth is huge. They just beat the estimates by 40%, saw revenue growth of about 28% year over year. That beat their own guidance. They guided, I think it was like 15 to 20%. They're kind of guiding conservatively, and then they easily beat that. They're guiding for this next quarter, third quarter, of 20 to 25%. So again, all the analysts are like, they're probably guiding conservative. The key to them has been the same thing that we just saw with Facebook. It's the mobile apps. They had about 20 million downloads of their mobile app at the end of last year, and they're already at 50 million. It's only about 15 to 20% of their revenue, but it's growing quickly, so it's probably going to replace most of the PC, and then I think they still have people calling up to
really?
place orders too.
Wow.
Between PC and mobile, it's about 55% of their revenue. So all that will be replaced mostly by the mobile apps, and they invested in it, and now they're reaping the benefits. So yeah, I like the travel area. They do both leisure and business, and again, the growing middle class.
Okay, Nick, you've got an oil and gas, MLP.
Yeah, Magellan. It's basically a pipeline and facility operator. You know, why do I like it? From a macro perspective, that's kind of what attracted me to it. If you look in the Middle East, you've got chaos in Egypt, you've got chaos in Syria, and you've had a lot of labor unrest in Libya. So there's probably a bit of a risk premium in the energy markets. Second thing, U.S. production is exploding. It's up 20% year over year over the last 4 weeks. So we're ramping up our production here. And then thirdly, because of this kind of search for yield with interest rates going up, it pays a nice a dividend, or I should say distribution. And it's got a track record of essentially growing that about 12% since 2001, 12% annualized rate. I think if you look at it more specifically, it basically is a Zacks 1, so its earnings estimate revisions are going up, so we like that. And I think that it's transactional. Most of its business is transactional, about 85% of it. So it's just collecting tolls as product moves through its pipeline. So I think it's got a bit of a defensive feature to it. And then lastly, its payout or its coverage ratio is over 1 and expected to be that way for the coming years. So that distribution should be fairly secure. Okay.
Eric, you're actually doing a stock this time.
I am, first time.
What's going on here?
Well, it's not too far out of my wheelhouse here. It's MSCI. In addition to providing risk and portfolio management services, they do a lot of indexes, primarily for ETFs. And they're actually the gold standard for a lot of international ETFs out there. Roughly $250 billion is tied to MSCI indexes in various ETFs out there, be it emerging markets, IFA, Germany, Japan, any number of countries out there. This is a great business to be in. Operating margin is about 37% here, and it's very scalable. You provide the index to the company, and no matter if they have $1 billion or $10 billion, it's exactly the same for MSCI to run. So they're going to get a asset-based fee there as well as a subscription. So it's going to be a very solid, stable business. Roughly 93% of companies renew on a yearly basis. So there's pretty much no risk of any losses from that respect. It's a #1 ranked stock, and it has roughly 20% earnings growth projected for both this year and next. So it could be a very solid pick in the short to medium term here.
Okay, thank you all for that. Don't forget more stock picks on our website, Zacks.com. If you're not there already watching this video, get on over. They change daily, so check back very often, like daily. With everyone here, I'm Terry Ruffalo.